right. I see Pablo just joined us. Pablo, if you want to go ahead and unmute yourself as well.
Hey, how's it going, everybody?
Can you hear us? Awesome. Perfect, man. Thank you. Thank you. Great. So I think we're good for now. We may get some people coming in and out of the meeting, but that's okay. I'll add them as they go. So again, I want to thank everybody for taking the time out of your busy Thursday. I know everybody's got stuff going on, but I really appreciate you guys taking the time to connect with us today, so that you can learn a little bit more about the benefit of starting your real estate journey through house hacking. Right? We're going to cover kind of all the basics there on what that means, how can it benefit you, and some pros and cons, and then we're going to obviously leave it up to questions. So let me just quickly share my screen. I want to make sure that, can you guys all see my current screen here?
Yes.
Yeah, perfect. Okay. Let's see. Sizing wise on this, is it good? Do I need to make it bigger, smaller? How's that? Is that good for everyone?
That's good.
Perfect. Okay. Awesome. Awesome. So Pablo, if you don't mind just monitoring the chat, because I'm sharing my screen, I don't see that anymore. So just monitor the chat. I told people as questions come up, feel free to throw them in the chat and we'll kind of answer them as we go. So again, we're going to touch base on house hacking your first home, what that looks like, how you can do it, and how you can use that to set up your real estate wealth and set yourself up for a good financial future. So before we begin, I want to just quickly introduce our quick panel here. So for those of you that don't know me, my name is Mauricio. I'm a licensed real estate agent here in Illinois. I know we've got some people from out of state, which is awesome. This system, if done correctly, can be done anywhere, you know, so you're going to learn some really good information here. So a little bit about myself, like I mentioned, my name is Mauricio. I'm a real estate agent here in Chicago. I've been doing this for about 4 years now, helping families buy and sell real estate, and really educating the young, especially the young Latino community, on the benefits of owning real estate and how that can really create some generational wealth if done correctly. I feel like, you know, for me growing up, you know, like my example, my parents didn't buy their first house until I was maybe like 11 or 12 years old. So we rented prior to that. And, you know, we're going to touch base on some of that and why that's, you know, maybe not the best move, knowing what you know now, being as educated as you can. So our goal is for you guys to learn as much about the benefits of investing in real estate and how you can set that up to create future success for yourself. I want to go ahead and introduce Pablo. So Pablo, if you want to go ahead and introduce yourself to us, please.
Yeah, so how's it going, everybody? My name is Pablo Lopez. I'm actually Mauricio's brother. So I've been doing real estate for about 4 months now. Prior to that, you know, got my degree at Michigan State, so I was doing some engineering stuff. But really, I got into real estate because of house hacking. Like, that was kind of the primary reason. I got my first multi-unit last year, and I just was like amazed with just how beneficial it was, and really just like what I wanted to do was just educate other people about it. So now with my, you know, journey in real estate, I'm kind of doing that, as well as just again educating everybody what it means to be you know, invested in real estate. And yeah, that's kind of my story.
Awesome, man. Well, thank you for that. And I want to go over and introduce our premier partner lender here, Jose Giusti with the Federal Savings Bank. So go ahead, Jose.
Hello, everyone. Thank you for joining us. My name is Jose Giusti, mortgage loan officer for the Federal Savings Bank. I've been a loan officer now for close to 5 years, been in retail banking for almost 10. And just like the both of you, what I really enjoy about what I do is really just being able to educate and just provide the tools that people need. A lot of this is just, you know, information and just planning ahead. So I'm really excited to share some of these tips with all of you today. I'm also licensed in all 50 states, so I'm glad to hear that we have some people out of state. And like Mauricio said, the process and the guidelines and a lot of that is the same. The only thing that changes are local laws, but the strategy is the same. So thanks again for joining us, and hopefully by the end of this session, you'll walk away with at least one piece of good information that'll help you plan your purchase in the future.
Perfect, man. Thank you so much, Jose, for taking the time as well. You know, like we kind of mentioned a little bit earlier, you know, there's a lot of information that we're going to go over that a lot of people may already know and may not know. So if this is all new to you, you're going to be learning a lot. If this is not new to you, hopefully this is a refresher in helping you, you know, start those next steps with investing in real estate. So through this quick presentation, we're going to cover some quick topics here. Primarily, the whole focus here is house hacking, right? What is house hacking? What does that mean? What does it look like? How do I do it? How can I take advantage of it? What are those steps look like? So we're going to go over all those details. We're going to go over why somebody's going to do it, how you can do it, right? The different ways you can do it. So we're going to briefly touch base on how you can house hack both a single family home as well as how you can house hack. And the more common way of house hacking is through a multi-unit building purchase, right? And then we're going to leave it up to questions, or we're going to answer questions as we go through this. I know a lot of this may be new to a bunch of you, so if any questions come up throughout this presentation, don't hesitate to put them up in the chat, and we'll be sure to kind of walk them through and answer those questions. So if everybody's ready, we're going to go ahead and get started. So house hacking, what is that? Like, what we hear that term being tossed around a lot here in the real estate space. What does that mean, right? What is house hacking? House hacking is essentially buying a property and renting out either rooms or units to have that rental income that you're receiving pay for the majority, and in some situations, pay for the full amount of your living expenses and provide you with additional income so that you can now set yourself up for financial success in the long-term goal. Like I mentioned before, this can be done with single family homes. There's different strategies that they use specifically on single family properties. So we're going to touch base a little bit on that. But it is most commonly done, like I mentioned, with multi-unit buildings. And especially as making this your first purchase within real estate, you can qualify for some of the loan down payment options, which Jose will touch in a later slide. But this is basically more commonly done on properties that have 2 to 4 units, okay? Now, why would somebody want to do this? Why would somebody want to house hack? So like I mentioned, house hacking gives you the opportunity to offset some of your cost of living expenses. In some scenarios, and really the ultimate thing with house hacking is that you have to know your numbers and make sure the numbers work for you. But in some scenarios, with house hacking, you're sometimes able to get the full amount of your rent covered so that you're living rent free, right? So that money that you would have spent otherwise on rent, you get to save or invest in other avenues, right? So it gives you an opportunity to kind of leverage that and build some wealth through that leverage. It's a great first step to learn some experience with real estate investing. You know, becoming a landlord through house hacking or having leases on properties. It's a journey in itself, and some people, you know, may need to learn more than others, and so this allows you to kind of have that first you know, hands-on experience through investing in real estate. And like I mentioned prior, as a first-time buyer, you can leverage the low down payment options that are available to you when you purchase your first property. There's obviously different strategies that you can do this, and Jose is going to be touching base on all of those cool benefits that you have as a first-time home buyer. This is a pretty easy transition, which is why it's a very popular strategy among recent college grads or young professionals, is because it's an easy transition if you've already lived in an apartment setting. If you're already kind of used to having roommates or having or being in an apartment setting, it's not going to be very much different. I mean, really, the roles kind of change for you, right? Instead of you being the renter that goes to the landlord if any issues come up with the property, you become the landlord and they come to you. So we're going to, you know, touch base on some of those pros and cons as we go through this presentation as well. Another cool thing is you get to pick your neighbors. You get to pick the people you want to rent the building to. Obviously, there's rules and guidelines that you must abide by, but you know, you can get people that you feel comfortable that you want to live with you and make it as easy as possible. And I think sometimes, and I'll let Pablo kind of attest to this, but you know, picking your tenants or choosing the right tenants can sometimes be a struggle in itself, but you learn from that experience as you go on. Pablo, if you want to kind of touch base a little bit on that briefly.
Yeah, so definitely, you know, obviously, like Mauricio said, like you get to pick your neighbors in a sense of you're gonna become a landlord, right? So you're gonna have to advertise the property, basically put it on different sites in order to get applicants to apply for it. And then from there, you just kind of filter out what's, you know, basically vet out all of the applicants and then kind of narrow down to who you want. And you know, that's kind of why in a way we're saying you get to pick your neighbors, because you really do get to vet out you know, all the applicants, and you know, see who's the best fit for the apartment and who you feel most comfortable with.
Perfect, man. And last but not least, obviously the biggest part of this equation on why people want a house hack is that it allows you to build your wealth, right? You have an asset, you're buying a property, you're having the rent from the units that you're renting pay down that mortgage. So your balance on what you owe on that property as time goes on gets lower and lower as you know the property starts appreciating year over year. So there's a there's an equity gap that keeps increasing over time, and you know you can do so much with that. And again, I'll let Jose kind of touch base on that in some later slides, but you can do so much with potential equity, and just opens up more opportunities for you to really kind of leverage your money and through real estate investing. You know, it's not, you know, it's very common that a lot of millionaires become millionaires because they invest in real estate, or you know they have a good amount of their wealth invested in real estate. And so people love that it's an actual asset that you can control. It's an appreciating asset, right? So you know the mortgage debt in this scenario with house hacking is essentially good debt because it's being covered by other people, right? So again, we're going to touch a little bit about that shortly. Here, let's see. Okay, so I wanted to put this out here because you know a lot of people rent. You know, I rented out of college. A lot of people rent out of college, and it's kind of the thing to do, right? Because you're a young kid, you're a young college professional or young adult, young professional, and it's you know the easiest thing to do is get roommates and start renting a property, right? So in this slide, I just wanted to kind of break down some of the numbers to kind of give you some perspective on what that looks like. You know, if you rented an $800 apartment, in a year, you would have paid $9,600 to your landlord, which if they still owe a mortgage, you're paying down their mortgage. But if they own that building outright, meaning they've already paid it off, then that's just straight profit that they are receiving, right? So, sorry, 1 second here. Yeah, so that is just straight profit that they are receiving from you every year. Imagine living in that same place, renting it for $800 for 5 years. You've given them $48,000. After 10 years, and $96,000. And this is assuming that your rent is going to stay the same for every single year. Because keep in mind, your mortgage is likely going to stay the same. It's going to be a fixed mortgage, but your rent typically year over year, rents tend to increase, right? So you might be paying more the longer you stay at a property. So just to kind of give you some breakdowns, kind of open up your mind and really kind of change your mentality on what these numbers and what this rent looks like. You know, why pay someone else's mortgage when you can have someone else pay your mortgage, right? Think about that for a minute. If you own a building and you're collecting $9,600 in additional, you know, income every year, aside from your full-time job, maybe you have a couple side hustles, whatever that may be, that's just another avenue that you can add to your portfolio of building your wealth. So, you know, with the opportunity to purchase a property at a low down payment option, you know, the numbers can kind of work for themselves. So, all right. So how do people house hack? What do you got to do? Like, how does it happen, right? So real quick, I'm going to just break down the different steps that are involved with house hacking. Obviously, these are the steps to purchase any property, but specifically how to house hack a property, right? So the first thing you do is you get pre-approved for a home loan. So you find out what your current amount that you can qualify for a purchase is. With a single family home, the qualifications are a little bit different than a multi-unit building. And again, I'm gonna let Jose touch base on that in a later slide. But you get qualified for a mortgage and you get a pre-approval letter so that you can start now shopping around for the different home options that are available to you. So you want to make sure that you're looking at the numbers, making sure that the numbers work for you to make an offer. So just as a scenario, let's say you're buying a single family home. It's a four bedroom, 2-bath single family home, and your mortgage on that single family home is going to be $1,500, right? And this is you by yourself, or maybe you have a partner or whatever. You have 3 other rooms, right? You could potentially rent each of those rooms for, 3, 4. We've even seen $500 a month per room. Imagine renting all 3 rooms for $500. You're collecting $1,500. If your mortgage was already $1,500, you're offsetting that mortgage cost. So you're essentially living rent free. So again, that money that you would have otherwise spent yourself to pay down your mortgage is being paid by other people, which means you can then reinvest that money or keep saving that money to then restart this strategy and do it all over again. So you would start shopping around for the different home options, look at all the available inventory that's out there. I mean, right now the market's a little kind of crazy with the lack of inventory, but there's still good deals out there. There's still ways to find opportunities. It's just a matter of, being persistent, getting involved with the right real estate team that can find, that use all avenues to find you the right options, whether that's not just properties on the MLS, on Zillow, Redfin, but looking for off-market opportunities, for sale by owners, all these different avenues to make sure that they find a property that works for you, for what you're trying to do, right? Once you do actually find that property that you're willing to move forward with, and you make an offer and they accept your offer, you enter what's called the escrow period. This is the time where the lender gets involved. You do an inspection, you do an appraisal. There's a lot of kind of little intricate details that happen in this phase of the buying process, and the timeline for that can usually vary. It can be anywhere as little as maybe 21 days to 45 or 60 days, because of everything that happens behind the scenes. But as long as everything's good behind the scenes, they'll go ahead and the lender will give you a clear to close. You'll actually close on the property, usually at a title company. You get the keys to the property, and the property then becomes yours. So one thing a lot of people don't realize is whatever month you actually close on your property, let's say, we're in July. Let's say you close on your property in July. Your first mortgage payment, meaning the first payment that you have to make to the mortgage company, is actually due in 2 months later, right? So it would be September 1st would be when your first mortgage payment is due. So if you're using this house hacking strategy, there's an opportunity for you to get some rental income for the month of August if you do this right. Like if you're able to get roommates to rent out some of these rooms and you start charging them right away, you're able to kind of build on that wealth system. So I mentioned that, right? Finding tenants, finding roommates for house hacking, a single family home, if it has like a lower level, like a basement or an upper level. Some people sometimes rent out a basement, or sometimes they'll rent out another level, or they'll rent out rooms like I mentioned. But it's another way to use that asset to generate more income for yourself. So finding tenants, finding roommates, and then begin, charging rent every month, right? Making sure that rent is collected every month. And you're using that to then pay down your mortgage, or using that to save more money, and kind of building on that wealth plan. And again, this strategy can be done kind of repeatedly if it's done correctly and if the numbers keep working for you. And this is why there's a lot of people out there that own 3, 4, 5, 6, 7 different single family homes or multi-unit buildings, and a lot of these people just live off that cash flow that they receive from the rent. So you get a lot of people that actually do retire early due to the cash flow that they're receiving, paying for all their living expenses, and they live a comfortable life. You see a lot of people out there like that. A great kind of podcast or resource to look into if people haven't already is called Bigger Pockets. If you really want to learn about real estate investing and want to get yourself immersed in that study, in that journey, the Bigger Podcast, the Bigger Pockets podcast, or they also have a website and a blog where everyday investors share their journey. They share how they've been working 9 to 5 and they've been building on their real estate portfolio to eventually be able to retire early, pay off debt, travel, do all these other things because they were able to leverage their money to make it happen for them. So that's how you house hack a single family home. The process to house hack a multi-unit property is slightly different. And I'm going to let Pablo kind of touch base on this because he has actual real life experience. He's currently doing a house hack with his current property?
Yeah, so basically house hacking a multi-unit, it's like I said, it's a little bit different because obviously like it's kind of a bigger building, it's not a single family, right? So making sure that it's essentially the same kind of process with a single family home as Mauricio was talking about in regards to like the whole escrow period, shopping around. It's obviously making sure the numbers work. That's the most important thing, is making sure the numbers work. You never want to get a beautiful renovated home, but then rent rates are only like $800 and then your mortgage is like $2,000. The numbers just wouldn't make sense, right? So it's making sure that all those numbers make sense. But in a sense of, actual like multi-unit, you can actually get a lot of additional income as well, because for example, like in a larger building, there might be just one laundry unit downstairs in the basement. You can switch that out, put in some coin laundry, and that's extra income. You could rent out the garage, that's extra income. So in regards to a multi-unit, it is a little bit different, and I definitely think you can produce a little bit more income.
For sure, man. And at the end of the day, it's all about creating those streams of income for yourself, man. A lot of people now have a lot of different side hustles. Owning real estate is one of those things where you make money in your sleep. You know that the first of the month through the fifth of the month, you're going to get a paycheck for that rent. It's written in that contract when you get a tenant. Obviously, there's things that can come up. There's issues that may arise. Just like with any other investment, there's always risk involved, right? But if you do it right and you use the right tools and resources and you set yourself up for success, it can become a very kind of minimal work needed, but can create some real wealth for yourself in the long run. So I want Jose to go and touch base on the finance side, how to get started through the financing. What's the benefit as a first-time buyer and everything like that. So
very good. As far as the process itself, it's not too different than to just buying a house, right? You're definitely going to have to go through the pre-approval process so that what your financing options are. What the budget is, right? So before you go out and start shopping, we've already heard a few times here from Pablo and Mauricio, the numbers have to work. You have to, during that process, I go through the differences between buying a 2, 3, or 4 unit property. So I'll give you an example. When you're buying a multi-unit, you're not using just your income to qualify, but if you're buying, for example, a 2 unit, or you're living in one, so we can use a portion of that, what's going to be the second unit's rental income, net rental income, right? If it's 3 units, then you're using 2 because you're living in one, so you're renting out 2. And if it's 4, then it's 3. So what that all means is that clearly you're going to qualify for more when you're looking at purchasing a multi-unit. Now, there are some differences in financing, especially with the two kind of most common types of loans, which are FHA and conventional financing. Now, when it comes to multi-unit specifically, the FHA option is the most attractive. Why is that? Because you can buy an FHA or a home or a multi-unit from 2 to 4 units with as little as 3.5% down. Where on a conventional loan, it does go up higher depending on the amount of units. If you're buying a 2 unit and you're living in it, that's 15% down. So clearly that means a lot more in terms of down payment and initial out-of-pocket costs. So the FHA option really is the most attractive option when most people are buying multi-units. And then later they can always refinance that into a conventional, and even in the future take out another FHA as long as they qualify and meet all the guidelines. VA loans, if anyone, if that's applicable to anyone on the session, those are also great options because clearly there's a lot of benefits that come with VA loans in terms of no down payment, no mortgage insurance, property taxes, not having to pay property taxes. So clearly if you're a VA or have that VA benefit, definitely you can definitely make use of that to your advantage for this house hacking strategy. And then again, we've already talked about the numbers, run the numbers. And what we mean when we talk about the numbers, you want to do a little research as to what the going rents are in that specific area that you're looking to make the purchase, right? What property taxes are in that area, because that's all going to be factored into your, well, the property taxes are going to be factored into your total monthly payment. And well, clearly, I think Pablo touched on it, it's that the numbers have to work, right? Depending on what those rents look like and things like that. And you also want to factor in expenses that are going to come with the property, things like water and even, garbage removal, right? So those are all things that, I like to the client, here's what a 2-unit pre-approval would look like, 3 units, 4 units. Now, some things change between purchasing a 2-unit and a 3 to 4. 3 to 4 units is going to require some reserves. But at the end of the day, again, the strategy is just a great strategy, especially for younger professionals that, like Mauricio said, might be used to that situation and renting and things like that. And then later on, as you get later on in life, you get married, your family grows, you can always buy a single family home, and clearly that rental income will continue to generate income for you and pay itself. So those are really the things that we look at. Again, the numbers have to make sense when you're looking at making that purchase. And you also want to be prepared for those unexpected expenses, right? Maintenance. And I always tell people, you want to make sure, just like a car, you want to keep maintenance on that so that you don't ignore something and then it becomes a bigger problem and then it becomes a bigger expense all at once. So keeping up with those expenses, and again, managing that budget, monthly budget, is really key. And really, let's just remind ourselves why real estate, right? Real estate is an investment, but it's a low risk investment. It's never going to go out of style. People are always going to need a place to live. So this is why real estate, for some people, it just makes perfect sense in terms of building wealth and using it as a platform to invest and get a good return on your investment, because again, it's a low risk investment.
Yeah, and depending on where you live, I mean, the rental income, the rent rates in that area typically tend to increase, year over year. So you've got that kind of guarantee in a way. But Jose, can you touch base on the benefit of like a recent college grad, right? What is the benefit of a recent college grad, or what's some of like the workaround that a recent college grad has, as opposed to somebody that's already been kind of working for a couple years? Because as a recent college grad, you just graduated, maybe you just got a full-time job, and you want to set yourself up for success. What does that look like from a mortgage perspective?
That is a great question, because typically, when you're applying for a mortgage, we're going to want to see 2 years of, W-2s or tax returns, things like that. The only exception is when you are a recent grad. So clearly, you're not going to have 2 years or, as a recent grad, but you can show your transcripts, school transcripts. We use that, as well as a copy of your diploma. And then for many college students that I've helped, they get an offer letter. So then we can use that offer letter, as long as it doesn't have any contingencies in it. We can use that offer letter to qualify the client. So those are things that are a little different from someone who just recently graduated college, as opposed to someone who's been in the workforce for 2 or more years. As far as what the bank looks like, is the same. So there's 3 things that the banks are always going to look at. That's credit, income, and assets, right? Your credit, clearly there's minimum credit scores that are required for different types of loans. And generally speaking, clearly the higher the credit score, the lower rate you're going to qualify for. Income, well, that determines how much the client qualifies for. That calculation, if any of you have heard, debt to income ratio, which is taking what the borrower makes on a monthly basis in terms of gross income compared to their monthly liabilities, and factoring in what that monthly mortgage payment is going to be. Again, with a multi-unit, the great thing is that we're able to factor in those other rents, right? So that is another huge advantage. And then just being able to, usually when I'm having conversations about people wanting to, invest in real estate or purchase a property, I always suggest get the multi-unit first. right? Because why? Because you're going to be able to get the multi-unit with a low down payment. And as I said earlier, later down the line, when your family grows and you decide to buy a single family home, you'll still be able to qualify for that single family home with a lower down payment, as opposed to doing it the other way, which would then, if you buy a single family home, you have a lower down payment, but then if you're buying a multi-unit, it's going to be treated as an investment property. And then that's when you're looking at 20-25% down for the down payment. So these are the advantages of doing this, especially with a multi-unit, is to take advantage of that lower down payment. Right now, clearly, rates are still low. So when we talk about running the numbers and making the numbers make sense, well, having a low rate also makes a huge difference. So it really is a great way to build wealth. And the process is not as difficult as many people think. A lot of people are curious, or they've heard, and there's a lot of bad information out there, which is why we always suggest to reach out, to a lender, someone like me, who's going to be able to provide you with all the answers and navigate you through any type of, special scenario or specific situation that you're in, so that we can go ahead and help you, secure that property.
Hey, Jose, looks like we got a question. So how is student debt factored into your DTI?
That is a great question. Great question. That's something that we see a lot. So the rule of thumb is, and it depends clearly on the type of loan too, and even the arrangement on the student loan debt. So right now, for example, after the pandemic, all of the student loans, they're being deferred, right? So when we're looking at that as a monthly liability, the guideline calls for us to use 1% of the total balance as a payment, right? So, if you have $50,000 worth of student debt, well, that's a $500 payment that we're factoring in. Now, if you're on an income-based repayment plan, then that's a little different. And that's actually ideal, because usually the income-based repayment plans on the student loans have a smaller monthly payment. And then we're able to use that versus having to use the 1% that the guideline calls for. Now, if you're doing a Freddie product, then we're able to just hit you for 0.5%. There's a couple of things that go with that, but that is, I'm sure everyone's hearing, and we're all crossing our fingers that, these talks about student loan, eliminating student loan debt and things like that actually does happen, because unfortunately, in some cases, that could be a challenge when qualifying for the loan, but not in every case. And again, it goes back to really just taking a look at your specific situation, seeing what those numbers look like, and then determining if there are any other options, or again, I've had cases where people are on a deferred payment plan and are able to take that out of deferment and then go back, I should say, into the income-based repayment plan. And I just had a case just a couple of weeks ago when we took the 1% of the $75,000 student loan debt, $750 payment that we had to use or count as a liability for this applicant. Well, it turns out that she was actually on an income-based repayment plan before the pandemic hit, and her payment was $80 a month. So she was able to get it out, get back into the income-based repayment plan, and we were able to use the $80 a month payment versus the $750 payment.
So the lower your debt to income ratio, the better opportunity for you to qualify for the loan, or how does that work?
Yeah, because all those numbers are factored into the max amount that you qualify for. So, a lot of people will ask me, well, how much do I have to make to qualify for a loan? It also has to do with your monthly liabilities. I've had people that earn $100,000 a year and don't qualify for a loan because they have a lot of debt. So it's having that balance, and again, just looking at your specific situation to determine what those numbers look like, and again, get a better idea of what your current situation allows you to qualify for. But student loan debt, and again, I'm glad that question was asked because that is a very common question. That's the way student loan debt is treated and looked at in the eyes of the banks.
So another question I get commonly asked is, and this is from a lot of the young professionals, is, you know, they don't have enough credit history built up, right? Or they think they don't, right? But a lot of people, you know, just like anyone else, you know, tech savvy, you use Credit Karma, you use like the free credit monitoring apps on your credit cards or bank, and you see a number, but then you know, actually get your credit pulled, and you see a completely different number. Can you kind of touch base on why that is, or what that looks like, and how like somebody can better prepare to either do anything to increase that score, or anything that they can do to benefit themselves if they want to apply for a home mortgage?
For sure. As far as credit, you know, those services you just mentioned, the Credit Karmas of the world. Now a lot of credit cards offer, you know, your FICO score and things like those are just estimates. And unfortunately, more often than not, what I've noticed is that those estimates are a little higher because sometimes when we pull the official bank report, which is the report that's used for the decision making on the loan, sometimes the scores come back a little different, a little lower, right? And sometimes I've had cases where some of the applicants get a little discouraged. So just know that those credit cards, while it might give you kind of a general idea of where your score is at, it's not necessarily what the score is going to be when it comes to applying for the mortgage and getting that official credit report pulled. Most people, I mean, yes, if you don't have any credit at all, well then, you know, the first step is going to be to establish some credit. There's a lot of ways of doing that. Secured credit cards are probably one of the best ways. If you don't know what a secured credit card is, you basically leave a deposit. So if you leave a deposit for $300, you get a credit card with a limit of $300 because your deposit is securing that. Where if you don't pay, you know, that credit card, well then the bank holds on or keeps that deposit. And vice versa. Once you establish credit, then eventually you get that deposit back. It's no longer needed because now you've established credit. Those are great ways of establishing credit. There's a lot of people that I hear, they think that buying a car is the best way. That's incorrect because now keep in mind, we're talking about numbers. Those cars, the payments are usually 4 or 5, and I've seen car payments as high as $1,000 a month. So that all factors in. It actually hurts you in terms of the amount that you qualify for, right? Another kind of credit hack is sometimes parents will add you, you know, to their credit card as an authorized user. That can also help establish, you know, credit. But those are all great ways. But, you know, again, it comes back. Sometimes I've had people that they don't think they have any credit, and all of a sudden we pull the credit report and there's a credit score and credit history from something that they took out or they were on, you know, from years ago. So it all depends. But, you know, no credit is definitely easier to fix than bad credit, depending on the specific situation.
Jose, last question we got was, you know, how long does a pre-approval last? Like basically, once you get pre-approved, how long is that valid for?
So the credit report is valid for 90 days. Usually after 90 days, then we have to pull credit again to refresh that pre-approval. Some lenders do it every 60 days, right? We saw that a lot of that during COVID because there was people getting furloughed and there was people getting hours, you know, their hours reduced and things like that. But typically it's 90 days. I mean, for my clients, and unfortunately, in this market, the buying cycle is a little longer because, as Mauricio mentioned earlier, there's lack of inventory. So what I do is usually I will, you know, speak with the client. If it's been 90 days, I kind of at that point it's kind of a little bit of an honor system. Hey, has anything changed? Have you applied for anything? Any new debt? If they tell me no, then you know. I'll verify a couple of other things and refresh that pre-approval so that we're not pulling credit every 90 days. But typically it's 90 days that your pre-approval is good for, assuming that nothing changes.
Thank you.
Awesome, man. Okay.
One of the questions when people are looking into house hacking is how long do I have to live in the property? Typically, it's a year, especially with FHA. You are required to live in the property for a year, and then after that, we talked a little bit about the numbers, right? So I'll kind of go through that again. If you're buying, for example, a 3-unit, your mortgage payment is $3,000 a month. You're renting those 2 units for $1,500 a month. You're essentially living rent-free. Now, clearly, again, you have to take into account, some of the other expenses. But once you've met that requirement and you've lived in the property for a year, then you can move out. Now you're renting that other unit, and now you're essentially, making $1,500 a month, assuming that you're renting that other unit at the same rate that you've been renting those other 2 units, right? And that's another thing why this has become, and why people are just buying houses in general, is that the cost of rents have just gone up. People are paying 14, 15. I've seen rents up to $2,500 a month. And as Mauricio said, you're already paying a mortgage. You're just paying your landlord's mortgage, is what we always say, right? So why not, take a little bit of time, educate yourself, and prepare yourself, and make that same investment in yourself and your future.
Yeah, sometimes it really just comes down to the sacrifice, man. Like, with house hacking, it's a year that you have to live in the property, but a year goes by quick, and there's so many things that you can do to like prepare yourself to set that foundation up, right? So a lot of people, especially recent college grads or young professionals, they sometimes due to their student loans and everything, they sometimes move back in with their parents, right? And it's a way to kind of save some money and build on that savings so that they can actually plan for their future and start this strategy. I mean, I did it. A lot of people that I know did it. I mean, it's the best way to kind of get started with real estate investing. But it's not all just
the way that
sunshines and rainbows, man.
Yeah, no, the way that I looked at it, right, is that like literally anywhere you live, you're gonna have to pay rent, right? You're gonna have to pay somebody, unless you live at your parents and you're lucky enough to like not pay rent. Anywhere, literally, you're gonna have to pay rent, right? So there's gonna have to be some sacrifices that you do make in order, I really think that, if you do make those small sacrifices, they add up,
That's a great point. Make the small sacrifices early in your life, so that then you set yourself up for success later down the line. And as Mauricio mentioned, maybe have the opportunity of retiring early and not having to, work until you're 65 or older.
Yeah, because Latinos tend to do that a lot.
Yeah, man, that's a sad reality, man. Is unfortunately we're just not educated enough, or nobody teaches us these strategies. It's crazy. My college roommate was a white guy, and right out of college, his parents co-signed on a condo for him because they had added him as an authorized user when he got his credit cards for college, and they had been paying everything. So unfortunately we don't have that luxury to kind of start early, but educating ourselves this way helps us kind of bridge that gap for future generations, man. That's the ultimate goal with real estate, and that's why a lot of people buy real estate, is you can hand that down. It's a physical property you can hand down to your kids to keep collecting on that rental income, right? So you're really building generational wealth if you start thinking of the long-term plan and the long-term game with this.
Yeah.
We got some more questions. Probably go ahead and see them.
Yeah, so one question was, what qualifies as living in a place for a year? I might join a specific area of my work that travels out of state to work.
Yeah, that's kind of a different situation. I mean, those are case-by-case situations depending on the type of job, if you're working remote, things like that. But for an FHA loan, it has to be your primary residence for minimum 1 year. And that means that that's your primary residence, meaning you're registered
That's where
there.
your mail goes, yeah.
You're filing your taxes there, all of your mail, your bills, your bank statements. That is your primary residence, right? I mean, if you're traveling for work and things like that, that'll all be taken into consideration. It may or may not affect, but it all depends, because there's a lot of different scenarios that can come about with these out of state, or working out of state for a few months and things like that. So it really all depends. But whoever asked that question, I'd love to, have a sidebar conversation or offline conversation and get into that specific scenario so that I can get you a better answer.
Perfect. And another question, Jose, is do you recommend getting an income-driven payment plan for student loans before applying for a mortgage, assuming it's less than 1%?
Yes, but I always tell people, see me first, right? Because it's just like the same people that sometimes clients sometimes start paying down collections and they didn't have to do it, right? So you might not have to do that, right? Now, once we take a look at the credit report, we run the numbers, then yeah, if that's going to be the best option in terms of what's going to give you and provide you the highest purchase power, then at that point, that would make sense as that client that I had just mentioned a few minutes ago. That really worked out well because there's a huge difference between an $80 payment, which is what she was paying, versus a $750 a month payment that we had to use with the 1%.
Mhm.
So to answer that question, have your credit checked, complete the pre-approval process, and then that will determine, what the best course of action is in terms of having to do anything with the actual student loan.
Yeah. And they also said, is your credit pooled when switching to an income-driven payment plan? Do you know that?
I don't believe so.
Yeah.
I know we clearly don't. I mean, we just pull credit at the initial time of application. I don't believe, I've never heard of that. I can probably double check on that with someone who has done that, but I don't suspect that's the case.
Yeah, I would. Yeah, I don't think either. But no, yeah, makes sense. Thank you.
Yeah, no problem.
So,
Perfect, man. So we want to open this up to some more Q&A if anybody has any other questions.
did you
that they
want to touch
kind of-
base on that other slide, Mo, the pros and cons?
Yeah. I'm sorry. I think I skipped that one. My bad. Here we go. Yeah. So like I mentioned, man, with every investment, there's risk involved, and especially with real estate, there is a little bit of work that goes into it, right? To setting it up correctly. And so, we talked a lot about the great stuff that comes with investing and becoming a landlord, but the reality is, there are some people out there, just unfortunately, they don't, they can't be landlords. They don't have what it takes to be landlords, or they choose not to take on the stresses of becoming a landlord, right? So we want to just go over some of the pros and cons and share some real world examples and experiences that we've had here. So on the pro side, I'll go through those. Obviously, you're building monthly cash flow. If the rental income that you're collecting will pay down your mortgage over time, assuming you've got a 30-year mortgage and you've owned it for that long, and the mortgage is paid off, then that rent is essentially money going to your pocket, right? The only thing you've got to pay at that point is insurance and taxes. So, you've eliminated that other part of the principal and interest of the mortgage. So that's additional cash flow that you're going to be building for yourself. And again, keep in mind, rental income or rental rates increase year over year typically. So you have the opportunity to increase that as well. Taxes obviously go up as well. So that kind of factors in too. Allows you to accelerate your savings plan. So again, you're one way or another, you have to, everybody has a place to live, and this strategy allows you to essentially live rent-free and then eventually start collecting positive monthly cash flow every single month until you either decide to sell or give the property to a family or whatever, right? So there is kind of like an unlimited opportunity there through real estate investing. There's a lot of tax benefits, a lot of tax, things that you can do with taxes. You can write off a lot of the maintenance and stuff that you spend on the building. I'll put out this disclaimer: we're not tax experts, so definitely want to consult with an accountant. But I do want to I brought this up because I do want to touch base on the importance of properly documenting or reporting your rental income when it comes to the time that, like, say you're ready to buy another building. What does that look like? Jose, I want you to kind of touch base on that.
Yeah, that's a great question as well. One of the most common mistakes that I see when people that have multi-units is that, let's say they collect $20,000 throughout the year in rents, but then they start deducting all of their expenses. And you're going to have expenses, but a lot of people, they might collect 20 and then they claim that they, had 19,000 in expenses, and therefore they're only claiming $1,000 for the entire year in rents. And that is again a very common thing when it comes to people.
Why would people do that? Can you just kind of explain why people do that?
It's to pay less taxes, right? Because that's income. So that's a great way to offset taxes. But if your plan is to buy another property, then that is important. And I always say, if accountants out there, tax preparers, just ask one question when people are getting ready to file their taxes, and that is, are you planning on buying another property this year? That would kind of, trigger like, hey, maybe you don't want to write off $19,000 in expenses this year. You might want to claim more because you're going to need that to qualify for the next property, right? Essentially to offset the property that you have now so that you qualify for the new one, right? So that is a common mistake. So it really comes down to, again, having the right team, asking the right questions, and just laying out that plan long term. If I say I want to, I would like to buy 3 buildings over the next 5 years, well then that's going to really drive you to want to include and claim as much income as possible so that you put yourself in a great position for the next one, to qualify for the next one.
Thanks, Jose. Another positive or another pro to buying real estate or buying an investment property is you're building equity on the property, and then over time, I kind of mentioned that equity gap, right? The longer you own the property, the more you're starting to pay down as the property over time appreciates in value. You're creating, that difference between what it's actually worth on the market to what you actually owe. That difference is called the equity that you own on the property. That's essentially, if you sell the property, that's what you would profit from that sale. But there's other things you can do with that equity too, and other ways you can kind of utilize that and leverage that to then buy other buildings. Can you kind of touch base on what that looks like, or what are some of the options that somebody can use to, if they want to strategize to buy more properties in the long run?
For sure, you can tap into that equity and use that as down payment for the next property, right? So you can do that in terms of what's called a cash out refinance, right? If that's your primary and you're buying an investment, you can also look into a home equity line of credit to tap into that equity. So this is really what, how that wealth is built, is that you have options then to really kind of, use money to accumulate more wealth, right? And buy more properties with that equity that, as you said earlier, people are paying for you because they're paying the rent in most cases, very little out-of-pocket cost, depending on the final numbers there. So yeah, having equity in properties, whether it's a multi-unit, single family, really allows you to tap into that and then use that. I mean, that's been a common thing here over the last year because of low rates, is that I've seen a lot of clients, refinance their current properties, tap into that equity so that they can go ahead and buy another property, whether it's an investment property or their next primary residence.
Looks like we got another question, Jose. So it says, let's say you, oh, I think he answered it. Never mind. Yeah, I think we're good.
Okay.
Yeah. Okay.
Awesome.
So
and then the last pro, sorry, let me touch on the last pro real quick, because we kind of touched on it a little bit. Like, you own the building, so you kind of make the rules, right? If you were a renter, your landlord sets the rules for the building, right? Quiet hours after a certain time, no pets, extra for renting a garage space, extra for having an extra person living in there with all these other rules that as a tenant you kind of have to abide by, right? But switching that scenario, when you become the landlord, you can kind of create those rules and make those rules, and it kind of ties into finding the right candidates, the right tenants that you want to be sharing the space with, right? Because essentially that's what you're doing. You're sharing common space with other people. So
yeah,
those are all the positives. And again, with positives, there's always negatives. There's always going to be some cons. We don't want to say that this is all, fun and dandy. It is a lot of work sometimes too. There are things that can go wrong. There are things that need to be addressed, in a very timely manner. So I want Pablo to kind of touch base on this and share some real world experiences, and Jose as well.
Yeah, so obviously one of the cons being that you can get bad tenants, right? Like they may look amazing on paper, it all might check out, but then when they actually move in, some stuff might just not go the way you planned it, and they just might be bad tenants, right? Another con can be that tenants can stop paying rents, which is, here in Illinois, it's a very tenant friendly state. So you as a landlord, you do have to protect yourself and, laying out all the lease agreements and kind of trying to protect yourself with any loopholes that they could kind of work around.
Our
So
recommendation is always consult with an attorney to help you put that leasing agreement together to make sure that you're protected as much as possible. Good
yeah,
point.
yeah. And then also, a con is that tenants will call you for repairs, right? So personal example, the P trap of, the sink upstairs was like a little loose in the sink upstairs. So my tenant called me like, hey, Paulo, there's a little leak happening in the bottom of the sink. Can you come check it out? I personally had no idea what to do. Looked up some videos, YouTube, TikTok, was able to get it fixed. But that's stuff that, like, you have to kind of be responsible for, right? And whether you don't know how to do it, either look up how to do it, or find the right person, either a plumber,
The right handyman, yeah.
the handyman that can do the job, right? So I think that's one of the key things when becoming a landlord is kind of have a list of contacts that, if it is a major repair that, hey, I just don't know how to do this, that you can call them up and say, hey, I need you to here to get this fixed, right? And another thing too, which is unfortunate, is that tenants can damage your property, and that's just the reality of it, right? It's just, I colleged as well, so I rented, so we did a lot of dumb stuff in our apartments, and that's just kind of the reality of it. It's just like it is going to get some wear and tear, and it's just, since it's not theirs, they're not as invested, I guess. That's just kind of how renters are, right? So just making sure, again, vetting out all the tenants and making sure that you get some good people that are in there, and that take care of the property like you would is crucial. Just because, again, these expenses, they can add up, and just my recommendation that somebody told me is that for the first year of while you're trying to do this house hacking, save up all the income of the first year as reserves, right? That way anything bad happens, it's like, hey, you have the money as kind of like a savings and ready to go, right? Because that's huge, because there are big things that can happen, like a personal experience. The AC upstairs, right? The AC in my unit up from upstairs, it actually stopped working, and I had no idea why it stopped working. I was like playing around with the control thing, and I just couldn't get it to work, so I had to call an AC guy. It turns out it was just like dirty, and they needed a complete whole like cleaning of it, and that put me back like 250. So it's just like those little things that you got to be ready to have those contacts and have that money as a little savings, little reserves, to make sure you're in a good place. You don't want to set yourself up for failure, and you don't want to be that bad landlord either, where it's like, man, like
Slumlord, yeah.
it's been literally, yeah, like a month, and this guy hasn't come and fixed this. Like, you kind of want to put yourself in their shoes as well.
Yeah, no, that's very true, Pablo. Jose, I know you own some investment property as well. Do you have any kind of insight on some either bad experiences or some, like, 2, 3 in the morning calls for a leak, or any sort of issues on that end? And you know what? I think he might have frozen.
Connection.
You're cutting in and out, but I think we can hear you.
Yeah.
I think we might have lost him, but hopefully he can come back at you.
So we got another question. I'll read
Perfect.
it. It says, a lot of people work on their homes without getting the right permits. How does that affect the landlord? Any tips on that aspect? I've heard of it affects you if you try to sell it. Yeah, so doing repairs and stuff, adding additions to your house without getting the proper permits, it will kind of affect you once you do sell it because basically prior to selling, it's going to need a pre-sale inspection, right? So let's say your house is set up as a 2-unit, but you end up doing the basement and turning it into another unit. Well, when you go and sell and the city comes and does the inspection and finds out, hey, like this is only a 2-unit, why is there a kitchen, why is there a bathroom, why is there a whole unit downstairs? That could come and kind of bite you in the ass. Like, sorry.
Yeah, no, that's the reality is, you want to make sure, and it happens a lot. That happens with a lot of homeowners. They tend to do things and upgrade their houses, and they think, they'll save the money on the permits because they just would rather save money. I mean, that's what everybody wants to try to do. And so some people avoid getting permits, but when it does come time to sell, your options are either going to be you bring it back to its original state before you did the work, or you either pay some fines and then still get the work inspected to make sure that it was done correctly so that, you don't have any issues. So my recommendation has always been, if you're going to do any major renovation to a property, get some permits or get a licensed contractor that knows what they're doing and can recommend the best options for you. But yeah, just know that it could potentially harm you when it comes time to sell.
Yeah. So another question is, out here where I live, people that own property with land tend to rent out horse stables. Can that income be factored in when getting pre-approved?
Horse stables. Do you live like in a rural area? I mean, I think that might be a question for Jose.
Connecticut?
Yeah, and unfortunately, I don't do many USDA loans. My instinct is that the answer might be no, but at the end of the day, it might also have to do with at the end of the day, it's what you are also reporting on your tax returns, right? But we could definitely write that one down and get back to that specific person on that. I mean, clearly it counts as income in your pocket, right? But in terms of qualifying income, I'm pretty sure the answer is no, but I'd be lying if I told you that I'm 100% sure because I don't do USDA loans. Most of everything here is in Chicagoland area. That's a great question.
So
Yeah.
real quick, while we're answering these questions, I wanted to just kind of put our contact information out here for anyone that's thinking of kind of taking that next step and wants to kind of see where they stand financially and maybe go through that pre-approval process. I included Jose's information down at the bottom, his email and his direct cell. If you guys have any direct questions to him, like he mentioned, he's licensed in all 50 states, so he can definitely assist you in that way. Myself and my brother Pablo here, we are licensed in the state of Illinois. So if any one of you that's on here is thinking about making a purchase in the state of Illinois and would like to go through those next steps and what that looks like and really dive deeper into the buying process, because we kind of touched it on a little bit here, but there's obviously more steps that are involved and it's a little bit more detailed. Feel free to, we put a quick QR code, feel free to take a photo of that. You can book an individual event in our calendars through that link. And yeah, I mean, we're looking forward to help you. If anybody that's looking to buy and is not in Illinois, we are connected with a network of realtors nationwide. So if anybody needs any referrals or recommendations of a great local agent that can help you in your city, we can assist you with connecting you to the right people with that as well. So don't hesitate to use this as a resource. That's kind of what we're here for. I think we got another question that says, how can we determine a reasonable rent in the area of the multi-unit to make sure the numbers work out? So most properties, and I don't know if this is specific to Illinois, it might not be, but here in Illinois, most properties, when a multi-unit, for example, is listed for sale and it's rented or it was rented, they'll usually put what the rent rates were for those units on there. So it gives you kind of an idea of where the rent could potentially be for that building. Other resources you can use is like apartments.com, Zillow. If you start just browsing to see what other available apartments are currently up for rent in that area, you can get a better understanding or an idea of what the kind of average rent in that particular neighborhood or in that particular city looks like. Another tool we use is a Rentometer, rentometer.com. You type in an address, you put the number of bedrooms and bathrooms, and it'll analyze some of the rents. There's a free version that you can use to kind of analyze some of the rents in a particular area. So those are all really, really good resources to help you kind of figure out and navigate the rental rates. And that's very important too, because you definitely don't want to, like, if you buy the building and it's your time to rent it out to tenants, you want to make sure that you look at the market rents so that you're putting out a fair advertising that someone's actually going to consider, right? You don't want to overcharge for rent and then not get any renters or any applicants because you're way above what the market dictates, and you don't want to undercharge because then you're going to get bombarded with applicants. So that's a good resource to use even after you've already purchased the property.
And something to note too is that, obviously be aware of the area that you're looking for in homes, right? Make sure that the area has a high renters market, because you want to have options when it comes to renters, you never want to have the only, multi-unit in, 3-mile radius kind of thing. It's a little bit different, so just be aware of that, because it can get kind of difficult to find renters at that point,
Yeah, and other things to consider, put yourself in a renter's shoes. What are the things that you're looking for in terms of amenities when you're looking for a place to live? Most renters, if they don't drive, they'll take public transportation. So how convenient is your location to access to public transportation? How convenient is your location to access to the grocery stores or the restaurants? All those things can kind of factor in and can determine, again, the type of demand that you'll get for your unit. So those are all things you want to consider aside from like just the numbers as well.
Yeah.
So again, if you guys want to take a quick screenshot or take a photo of this with our contact info on here, please feel free. Do we have any other questions? Does anybody have anything else that they want to throw in on the chat? These were all some really, really good questions. I'm happy we got some awesome questions. Did everybody learn something new? I mean, let me ask that. Did you guys learn something of value here with our time today?
Yeah, feel free to unmute yourself, talk. Go ahead. It's cool.
Yeah. Awesome. Thank you guys. Awesome. Very important.
My question to the group would just be like, what do they think is their biggest challenge to getting started?
That's a great question.
I think I know
what's
what the
stopping
answer
you?
is. Right.
That's a good question. Yeah. What's stopping you? I mean, a lot. I'll tell you kind of some experience that I've seen from a lot of clients that I've worked with. Sometimes having a bad credit score, so not having your credit ready, prevents people from starting. Some other people think taking on too much debt or having a lot of debt. Oh, they just brought it up. Yeah, I'll have a lot of debt. And those are things that, again, having that conversation with the lender who can actually look at your financial profiling and help you kind of determine the plan of action. And it all comes down to just creating a plan. If you have a plan to kind of work towards to fix that or find a solution to that, then you'll be able to make it happen. Everything, nothing is impossible. That's a good one too.
Yeah.
Not having enough money for the area.
Yeah, so saving money, that was definitely a hard one for me. It's just kind of my biggest tip on that is creating a budget sheet. Creating a budget sheet and being disciplined with yourself to know that, hey, this is X amount of money that I can spend, and obviously, we're young, we're trying to, have fun, we're in our 20s type of thing. But at the end of the day, right, it's making those small sacrifices that add up. So maybe instead of going out Friday, Saturday, Sunday, hey, I'm gonna take Sunday off. Like it's literally like those small sacrifices, they add up. And it's kind of like bigger picture, right? The sacrifices that you should make today will pay off tomorrow, kind of thing.
I'd also like to remind everyone that there are down payment assistance programs out there. If you qualify, that could be a great avenue. You're also allowed gifts, right? I mean, if you're a college grad, maybe instead of asking, for a car, maybe you ask for the money for the down payment for your home. So like Pablo said, and I get it, everyone wants to, we all want to have a little fun, but it's these small sacrifices that you make now that will allow you to have fun later and throughout the rest of your life and not have to work, multiple jobs and live check to check, to make ends meet. So little sacrifice now will pay off later for sure.
Definitely, man. Definitely. Well, if there aren't any other questions, we want to thank you guys again for taking the time out of your Thursday to sit with us. We went through a lot. Hopefully you guys learned something new, and hopefully you're a little bit better prepared, and don't feel as intimidated with starting the process, whether you do want a house hack or you just want to buy a single family home for yourself. Whatever the case is, we're here to help, we're here to guide, and we're here to educate. So if there's any questions at all, don't hesitate to connect with us. Stay connected with us. Follow us on social media. We're always posting some great informative tips, and we're always happy to help anyone that's looking for the help.